Welcome back to The Explainer. Today, we're diving into an absolute giant in the energy space, TC Energy, ticker TRP on the Toronto Stock Exchange. We're going to do some detective due diligence right now to answer one very specific question. Is TC Energy actually still a safe long-term compounder at today's price? Now, if you follow energy infrastructure at all, you already know TC Energy is a behemoth. They operate these massive networks of natural gas pipelines, liquids pipelines, and power generation assets that stretch all across Canada, the US, and Mexico. But, as value investors, we know that simply being a giant doesn't automatically mean your stock is a great buy today. A massive footprint usually comes with massive complications, and that is exactly what we're going to investigate. So the central tension of this whole analysis basically comes down to one elephant in the room. Is the safety of their nearly 4% dividend yield really worth stomaching almost 62 billion Canadian dollars in debt? I mean, that is a massive anchor. This is literally the core dilemma for anyone looking at TC Energy right now. You're basically stepping onto a scale, and you have to trade heavy balance sheet risk on one side for incredibly stable, predictable infrastructure cash flow on the other. Here's our roadmap for today. We're going to hit the business summary and deep dive, intrinsic value and mispricing, our SWOT and scenario analysis, exact price targets and returns, and finally, our final verdict and takeaways. Okay, Section 1, business summary and deep dive. Let's take a closer look at the suspect and how exactly they make their money. What's truly fascinating here is that TC Energy essentially operates like a giant infrastructure toll road. What that means is they get paid a fee just to move the gas from point A to point B. They completely avoid the wild, unpredictable price swings of drilling and exploration. They aren't pulling the natural gas out of the ground, they just build and own the highways it travels on. That distinction is absolutely critical because it means they generate really stable, contracted, and regulated cash flows even when the broader energy markets are just acting completely volatile. And honestly, this brilliantly illustrates their durable competitive advantage. Think about it. Building new pipelines today is incredibly difficult. That makes their existing assets strategically irreplaceable for decades to come. I mean, securing environmental approvals, negotiating with local communities, cutting through red tape across multiple governments, and just the sheer billions of dollars required, it makes it economically irrational for a competitor to come in and build a pipeline right next to theirs. It's a massive scale advantage. Plus, natural gas is going to remain completely essential for stabilizing our electricity grids and feeding the growing LNG export market, so the long-term outlook for these assets is highly, highly favorable. But here's the crucial point. While their profitability and free cash flows are fantastic, that staggering $61.87 billion in debt acts as a severe anchor on the balance sheet. Let's look at the metrics. Profitability is exceptional. We're talking a 47.5% operating margin. Once that pipe is in the ground, it costs almost nothing to keep it running. And free cash flow has improved materially, hitting nearly $3.8 billion over the trailing 12 months, which is a great turnaround from negative levels a few years ago. But man, that balance sheet is heavily leveraged, with a 166.5% debt-to-equity ratio. In a world where interest rates aren't zero anymore, servicing that debt eats directly into the cash that could be going into your pocket as a shareholder. Because of this, at the current price of around 88.61, the stock offers a very limited margin of safety. So, how is the management team handling all this? Well, weighing their strengths against our red flag scan, we definitely see a competent team keeping those dividends flowing, but it comes at the cost of aggressive, highly leveraged financial structuring. They've undeniably done a great job steering this massive, complex, cross-border enterprise and turning the free cash flow positive. But, their historical appetite for debt-funded capital expansion, especially in a world of rising interest rates, is a major red flag we absolutely cannot ignore. All right, moving on to Section 2, intrinsic value and mispricing. Let's dive into the financial evidence and see what this stock is actually worth on paper. Crunching the numbers, our conservative intrinsic value estimate sits right at 77 Canadian dollars. So at its current market price of 88.61, the stock really is offering a very limited margin of safety. We get to this $77 figure by blending a discounted cash flow model, assuming a modest 4 to 5% free cash flow growth, with a multiple of enterprise value model. These models are great because they strip away market noise and let us look purely at the cash the business actually generates. Either way you slice it, buying at nearly $89 means you're paying a noticeable premium for this infrastructure today, rather than getting it at a discount. Now, since TC Energy is an income-oriented stock and not some high-growth tech compounder, the PGY ratio is actually far more useful for us here. It shows how the dividend yield materially improves the valuation's attractiveness. If you just look at the standard PEG ratio, which measures price and earnings against growth, it looks terribly expensive at 3.36. But wait, The PGY ratio adds the dividend yield into that growth calculation, and that drops the multiple down to a very attractive 0.43. Yield matters heavily when you're valuing mature pipelines, and factoring it in gives us a much fairer picture of the whole shebang.
So, our conclusion? The stock isn't drastically mispriced. The market actually sees both the beautiful pipeline assets and the ugly debt load with totally clear eyes. Investors know they're buying an essential, durable business, but they're also acutely aware of the nearly $62 billion in debt and the tough regulatory hurdles for future growth. There's no hidden treasure here, folks. What you see is exactly what you get. A durable business carrying a really heavy backpack. It's a reasonably priced stock poised for moderate returns, not some deep value mispricing waiting to explode upward.
Okay, Section 3, SWOT, risks, and scenarios. Let's map out how these factors perform under pressure.
We ran a weighted SWOT table, and it gives us a total score of 6.72 out of 10. That underscores that this is a solid, resilient business held back almost entirely by its heavy leverage. We assign weights based on what actually matters most for long-term viability. That irreplaceable infrastructure pulls the score way up. It gets a 9 out of 10 in our highest weighted category. But that high leverage is a glaring weakness, scoring a dismal 4 out of 10. That basically drags the overall grade down from being an elite, pristine investment to just a good one.
Comparing these scores head-to-head, we see a moderate risk level driven by financial stability concerns, balanced against a solid opportunity score backed by fantastic unit economics. A risk score of 6.1 means this isn't highly speculative. I mean, the underlying business is incredibly stable, but that balance sheet isn't exactly a fortress either. On the flip side, the 6.7 opportunity score shows the economic moat is super strong, even if the current high price limits your chances of massive, explosive upside right now.
Let's map out a few scenarios. Unless you're betting on a massive drop in interest rates and strong LNG demand, which is our bull case, putting it at $95 to $110, the current $88 price tag just doesn't make a lot of sense for new money. In a bear scenario, with stubbornly high rates and regulatory blocks, value drops into the 55 to 65 range. Our base case, assuming moderate debt paydown and steady cash flow, puts the true value between $72 and $82. This firmly reinforces our finding that at $88 today, the margin of safety is just incredibly thin.
Moving to Section 4, price targets and returns. If we want to build wealth safely, what exact price do we actually need to pay? Using our rule of 9%, which calculates the maximum price you can pay today to guarantee a 9% annualized return, we see that over a 16-year holding period, we'd need to buy shares at a maximum price of CAD 59. This factors in a projected long-term fair value of $140, which includes dividends and moderate business growth. Now, if you're satisfied with just a 6% return over 16 years, buying at $84 works fine. But come on, as prudent value investors, we want a better return to compensate us for the risk we're taking on that debt load. That means we have to be extremely patient and wait for a significant dip. Conversely, if you want that same 9% return but over shorter time horizons, your maximum buy price changes pretty significantly. It drops to CAD 75 for a 10-year hold and CAD 69 if you're holding for 12 years. The longer you hold a mature, dividend-paying stock like this, the more time the mathematical magic of compounding has to work. But the core lesson here is that you have to buy it at the right entry price to give that compounding the runway it actually needs to work for your portfolio. Finally, Section 5, final verdict and takeaways. Let's bring all this evidence together and wrap it up. So, the final takeaway is this. While TC Energy is absolutely a premier infrastructure asset with fantastic cash flows, the current $88 price tag severely lacks a margin of safety. That makes it a solid hold for existing income investors, but definitely not an aggressive buy today. If you already own it, the nearly 4% dividend and the durable moat make it worth keeping as a reliable income generator. But if you're looking to deploy fresh capital, patience is key here. Let the market come to you. Wait for a broader macroeconomic sell-off to drag this down below 70 Canadian dollars before you even think about aggressively accumulating shares. Ultimately, TC Energy forces us to ask a really difficult question. In investing, is the safety of a wide moat really worth sacrificing your peace of mind over a literal mountain of debt? Think about that as you review your own portfolio. Well, that wraps up our explainer and due diligence on TC Energy. Do me a favor, drop a comment below and tell me exactly which stock you want me to analyze for you next.